You can't be a successful trader if you have not studied these 5 concepts you are going to talk about in this video. These are things you have to study before you can be a successful trader. In order to make your trading journey to be more smoother than expected, to kill your frustration, these 5 concepts you are about to talk about in this video are the most important concepts you have to understand before you have a successful trading journey. Without the understanding of these concepts, you will continue in a cycle and you get frustrated at some point you get out of the market. If you are coming across my video for the first time, this is A.O.S Channel, where you learn about trading psychology, where you will be prepare your mind, your mental health towards trading. And for more video like this, subscribe, like, and share. After the end of this video, these 5 concepts we are going to talk about will help you to see trading in another dimension, in another shape, because it will help you to think like a trader, to help you to think positively like a trader. The first concept we are going to talk about in this video is capital management, because capital is the only thing that keeps you in the market, that keeps you alive in the market. Once your capital is gone, you are out of the market, and you have to go and look for another money to reload your capital. And if you do not know how to manage your capital effectively, if you don't manage your capital very well, you realize that you keep wasting your resources. You can even sell your stocks to trade. One of the best way to manage your capital is to trade with the amount you are willing to lose. Let's say, for instance, now you have $1,000 your savings, and you put all the $1,000 in your capital as trader. You realize that you put all the pressures of your bills on that $1,000, and you continue looking for high percentage risk to reward. And when you continue looking for high percentage risk to reward, you are just a step away from losing that capital. And this is the main reason you have to trade with the little you can afford. And the second way to manage your capital is to trade with little percentage. When you have $1,000 account, only trade with 1% or 2% of your account. If not, you will realize that you continue blowing up your market. Let's say, for instance, now if you use 20% of your capital to enter a trade, and the trade go against you, you repeat that in 5 times, and if that trade go against you in 3 out of that 5 times, your capital is gone already. And this is because you did not trade with little percentage of your capital. The next concept we are going to talk about in this video is risk to reward, because market on its own is risky. Anytime you open your laptop or your system to trade any kind of PS, there is high probability of losing your money. And if you do not understand the advantage of the risk you are taking, if you don't understand what the risk you are taking is doing to you, you continue losing your money, because you have to understand the kind of risk you want to go and face in the market. Reward is the compensation of what you get from the risk you take, and this is why it is very important for you to set stop loss. Which is more important for you to set your stop loss? If you did not set your stop loss as a trader, or you do not know how to set your stop loss, then you are very possible to lose all your capital in one trade. Everything you've put in that account, you can lose it in one trade. So you have to understand how to set your stop loss. If you did not set your stop loss very well, you are out of the market in a very simple move. When the market is volatile or not volatile, if you do not set your stop loss and the market moves against you, you are out of the capital. You have to go and look for another capital. Other things stop loss helps you to do to your trading is it helps you to lose some certain of percentage from your position. If you enter the position with $10 or $20, and stop loss can help you to lose $5 or $7 from that entire $20, because setting your stop loss is now very important, because if you do not set your stop loss, you are killing your trade. And to become a successful trader, it will be a rough journey. You won't attain that position. You won't be able to get what you want from trading. And if you are entering any market or want to buy any pairs, make sure that your reward is bigger than your risk. Because if your reward is not bigger than your risk, maybe it's 1:1, you are just in one position, you won't make the capital, you won't go forward in trading. It does not mean looking for big in trading. You can't achieve big reward at once. Trading is a journey, understand? Then it's just like setting it to be 1:2 or 1:3 risk to reward. The third concept we are going to talk about in this video is leverage management. The leverage is like you borrowed money to buy bigger than your capital. It's like borrowing money to maximize your purchase. And imagine you have an $100 account. Leverage will help you to trade like you have a $1,000 account. The extra $900 on that $1,000 is leverage. It's a borrowed money. It's a borrowed money. And setting high leverages in your trading, it will help you to burn your capital faster than you expected. Small moves against you in high leverage, your capital is gone. And small move in your position in high leveraging, you will earn bigger than expected. So why using high leverages when you can earn anything you want to earn little by little? Then the advantages of low leverages is that it will help you to keep your capital. If you are using high leverages in trading, it means fast profits with a very fast loss, because any moves against you in the market, your capital is gone. And if you are using low leverages, it means slow profit with a very low loss. So that is just the concept. In trading, you have to know how to manage your leverage. If you don't know how to manage your leverage, you are one step out of the market. Just one step now, you are out of the market, and you have to start afresh again, looking for another capital. This will not make you be a successful trader if you do not know how to manage your leverages. And the fifth concept we are going to talk about in this video is position sizing. You have to learn how to size your position, because position sizing, it will help you to understand how much you are willing to lose in this market and how much you want to win in this market. Position sizing helps you to answer that question that says that if this market goes wrong, how much am I willing to lose? Like, for instance, now, if you have food on your table and you eat it fast, you eat it at once, you still get hungry. But if you eat it little by little, you will still be hungry, and you will still have something left out to eat. That is why we said you should manage your risk very well. If you want videos about risk management, you can check my page. There videos I've posted there about risk management, on how to manage your risk. Position sizing will help you to understand how much you are willing to lose and how much you are willing to gain in a particular trade. This is why it's important to trade with only 1% of your capital. If you have $1,000 account, enter the trade with $10 only. This will help you to keep large percentage of the capital. And the fifth concept we are going to talk about in this video is the market risk. If you do not understand the risk you are facing in the market, you can't go far in trading. You can't attain that height of successful trader. You can't be a successful trader if you do not understand the concept of that risk you are going into, because risk in trading is a chance of you losing money anytime you go into the market. And if you only think about capital, about success, if you only think about success in trading, you do not think about the risk of losing money, you are one step out of the market. So you can never be a successful trader if you do not know how to manage your risk or understand the risk you are facing in the market.